Where a farmer is operating as a sole proprietorship, they have their own form, unique for farms. As more and more farms are being converted to corporations, fewer and fewer Schedule Fs are being completed. Presently, they appear with only 2% of the 1040 returns submitted to the IRS. Normally, I would be reluctant to spend time with such an infrequently used form. But if a professional tax preparer is in a rural area of the country, they may find several such clients and need to complete this form more often than the average tax preparer. The IRS considers the raising of livestock and crops both when defining a farm. So whether an individual has cattle, wheat, or both, they are considered farmers as it relates to this form. However, businesses that simply service this industry, such as veterinarians and tractor repair companies, should not use this form. Furthermore, businesses raising and caring for pet animals rather than farm animals are not farmers under the IRS definition either. There are a number of similarities between the long-form Schedule C and Schedule F. Once you know how to fill in one, you'll be much more comfortable filling out the other. The only baffling part may be understanding the terminology. If you haven't farmed before, you may not know what a commodity credit corporation loan is or a cooperative distribution. These are all defined in the book, so before meeting with that first farmer, take a few minutes to read through the various definitions. Schedule F has three primary parts. The first and the third are to list the various forms of income that a farmer reports having had during the year. If the farmer is functioning under one of the inventory rule exceptions, which most are, you'll use Part 1. If, on the other hand, you know they're not using the exception, you'll have to use Part 3. For purposes of discussion at this point, it's enough to simply point out that you'll most often use Part 1 and ignore Part 3. In Part 1, the most common revenue sources for a farmer are from sale of livestock or other crops. The second part is a list of different expenses that a farmer typically reports. These amounts should be provided by the farmer. If the farmer includes expenses that aren't included on the list, then list them under other expenses. If the 6 blank lines aren't sufficient to show all the expenses, you can attach a handwritten or typed list to the form. Once you total the expenses, you'll subtract that number from the gross income in Part 1 to arrive at a net farm profit or loss. If it's a profit, you can then carry that number to the front of the 1040 as another type of taxable income. If it's a loss, the amount of loss to place on the 1040 may be limited. In this unusual circumstance, just follow the directions on the form and it will tell you what to do. Some taxpayers may have what I call a little hobby farm. It's usually just a small plot of land adjacent to their home where they grow produce for sale to the neighbors or local grocers. Unfortunately, this can be more therapeutic than profitable, and as a result, it shows losses year after year. Beware that if it doesn't show a profit every 2 or 3 years, it should likely be a hobby instead of a business, in which case other rules apply. We'll discuss these later in this module. One more note, often a farm is jointly worked by both the husband and wife. In this case, they can elect to file as a joint venture by completing 2 identical Schedule Fs, each showing half the revenues and expenses. The only difference would be the name of the husband on one and the name of the wife on the other.